Well, let's move on then. It's time for our special segment, Quarter Se Quarter Tak, where we get you expectations from each sector. Today, Mangalam joins us to help us out with what are the expectations from the FMCG sector. Mangalam, take it away.
Well, for the FMCG sector in the third quarter, let's first look at the demand environment, or rather the entire environment from either a demand input and even a cost and category perspective. From a demand standpoint, there's been no major change in conditions since the second quarter itself. Yes, there has been a gradual rural recovery, but urban demand is still sticky and struggling. Even as the festive season may support QOQ growth, there are a bunch of categories that may be impacted because of delayed winter. You know, the kinds of skincare products or healthcare products that we've seen with the likes of Dabur, etc. as well. The third quarter also saw the return of inflation in some key raw materials like palm, PFAD, as well as leaf tea, key inputs for some of the companies like Hindustan Unilever and some of the soap companies as well. However, there was some support coming in from crude and VAM that is used by paint companies, but then again, they're seeing competition. Pidilite as well uses VAM. Speaking of paints itself, there is high competitive intensity in the sector along with beverages where Campa has garnered 10% market share in some of the key states. The growth of quick commerce has far outpaced that of general and modern trade, which may impact some channel inventory for a few companies as well. There has been a good pickup in sales of apparel retail companies. That's what we've seen from the numbers that have come so far and from the results that have been reported so far in terms of updates. What we know is there have been weak updates coming in from Godrej Consumer, Dabur. There has been some margin compression for Marico, even though the revenues out there have grown in mid-teens. And at the same time, we are seeing, some of the others that have come by. The jewelry space, for instance, that did well in a seasonally strong quarter on account of higher gold prices and the festive season, with Titan reporting 26% growth and Kalyan Jewellers 41% growth in their India jewelry business itself. What are some of the key expectations then from companies like HUL, Tata Consumer, Britannia, Nestle, Trent? Middling sort of growth seen for HUL and Britannia, as well as Nestle, low single digits to about mid-single digits. Good growth seen for Tata Consumer on the revenue front, but then again, margins are likely to compress. And for Trent as well, it's likely to do extremely well, 38 to 40% in terms of revenue, 30-35% in terms of EBITDA. But the important part is that how much of that is in the price already. For the third quarter, jewelry sector will outperform, whereas staples, F&B and paints will underperform. There is likely to be some recovery in QSR after 8 muted quarters. And in terms of stocks, Pidilite may outperform because other paint companies are facing stiff competition. And finally, we're looking at Honasa, the accident of the second quarter. That'll be key to track in the third quarter itself. And apart from the numbers, the management commentary is something that we'll keep an eye out on, especially on expected pickup. And even we expect some impact coming in from government support schemes, the likes of Latki Bahin, etc., to aid consumption. All eyes will be on the budget. We're less than a fortnight away from the union budget. So announcements there, especially for sectors like tobacco, etc., will be important. From a valuation perspective, FMCG has not particularly been cheap, but the relative underperformance of FMCG stocks have made their multiples a lot more palatable than their historic valuations. Recovery in growth and earnings would be the key trigger for a lot of investors and analysts who are still on the sidelines when it comes to their stance on this space.
Okay, all right, got that. Mangalam, thank you very much for that. So that's the expectation from the consumer space, specifically from FMCG in this quarter. To talk about this and to take the conversation forward, we have with us Kunal Vora, Head of Equity Research at BNP Paribas. Kunal, great to have you on the show. So, I think the expectations are running high considering the market's kind of starved of ideas now in this, mixed environment. You tell us, can we look out for growth? Let's start with the staple companies and tell us, average volume growth, can it inch above, low single digits to, mid single digits? That's been the kind of range for the better part of this year so far.
Yeah, great to be on the show. Thanks for having me. So like Mangalam covered it well. What we've seen is fairly stable demand trends. No real excitement which is coming in. We've had FMCG go through a rough patch in the last few quarters with low single-digit volume growth. There is some pickup in rural at the same time, nothing really exciting. If I look at the agri GVA, it was like 1% in first quarter, 2% in second quarter, about 3.5% expected in third quarter. So nothing really changing dramatically. While there is some pickup in rural, nothing big. On the urban side, the mass consumption clearly did slow down in the previous quarter. This quarter, the commentary which has come in from the companies so far does not really indicate that there is any meaningful improvement in demand trends. So you will expect most companies to deliver like say low to mid single digit volume growth. And at the same time, there is some pressure which is coming in on the margins. So last few quarters, we did see while the revenue growth was muted, margins were well supported because of lower commodity prices. But that's changed since the previous quarter, last quarter. As Manglam highlighted, like many of the FMCG key raw materials, especially the agro-driven, which are like wheat, sugar, milk, you got palm oil, all of these are seeing some inflation now. So the trends in terms of margins are reversing. So while we are expecting the revenue growth to be about 5-6% on aggregate, we expect EBITDA growth to be lower at about 3%. The sector is going through like a weak growth phase. There were expectations that second half will be better, but so far the management commentary does not really indicate that. And we believe that the modest growth will continue. Pricing is moved up, inching up a little bit. That should take the revenue growth up a bit compared to what we saw in the last 2 quarters. But on volume front, we don't really expect much of an improvement.
Let me reiterate that number. That was a really sobering number. Nothing great. You said, if I heard you right, you said about 4 to 5%. And was it top line growth or volume growth? And then you said EBITDA growth is going to be even lower at about 3%. Can you just repeat the numbers?
Yeah. So about 5% revenue growth and 3% EBITDA growth for the companies which we cover on aggregate. So yeah, nothing really exciting there.
Okay, so let's try and pick a silver lining here in this rather sort of somber cloud. Relatively speaking, which are the companies which you think can unleash their operational efficiency and kind of tide against this rise in raw material inflation, maybe have some price elasticity at all? I don't know if anyone's thinking of price hikes, but relatively speaking, who do you think can manage this the best?
Unfortunately, there is no silver lining, at least which I see this quarter. So the EBITDA growth expectation which I have is anywhere between -5 to +5. So even the best of the lot will be more about like mid-single digit EBITDA growth. So while there is some pickup in revenue, like say if I look at revenue growth, there will be some companies like Marico which have had like commodity price increase will like deliver like say low teens kind of revenue growth. But even there, the margin pressure will be fairly elevated. So when it comes to the EBITDA line, we don't expect any company getting to double-digit EBITDA improvement.
Okay, slightly longer-term question, not just Q3. This change in the channel mix, right, with quick commerce becoming such a huge sort of part and parcel of life now. What impact do you think this is having, if at all? I mean, Dabur, we all know, we all remember that they called it out. But are other companies going through this? And does it cause any disruption in your overall projections as this channel grows in scale and size?
Yeah, in fact, this is one of the themes of our 25 outlook, that disruption is visible across consumer businesses. These businesses get the kind of multiples which they get because they are expected to report moderate growth, which can be low double digit and with minimal disruption risk. But as I see right now, like you highlighted quick commerce, but like there is disruption visible in various consumer businesses. So if I look at like consumer staples, both branding and distribution. On branding, consumer companies had a complete control through television. Today, through digital, branding can be done by anybody. Yeah. On distribution front, what we are seeing is earlier they had a very strong hold on distribution, which was extremely fragmented. Today, distribution again is going through a consolidation. You have modern trade, e-commerce, quick commerce, and in top cities, these are almost 50%. As they become larger and larger, they will be more and more demanding. And we are at a stage where the growth has been slow. If I look at last decade, revenue growth has been 7-8%. But the consumer companies managed to report decent earning growth through margin expansion. But as we are right now, where we are right now, margins are at a fairly elevated level. There is competition coming in from the unorganized at the bottom end. And at the top end, there are niche brands which are coming and competing. So the setup is not really great. So you have margins which might be very close to the peak and the growth which remains fairly muted and with additional risk coming in from the various disruptions.
Absolutely, Kunal. That's a point very well made and very well taken as well, that it's not just the change in the channel mix, but yes, branding and marketing. I mean, nowadays you don't buy whatever the ad tells you. Consumers are buying whatever is most convincing on their Instagram algorithms, right, in the feed. So absolutely, digital has changed the rules of the game. Thank you very much. Good conversation. We look forward to more as we go forward.